Canada enters late 2025 in a cautious but steady posture. Think of the economy as a ship that has slowed to navigate choppy waters, still moving forward, but constantly trimming its sails to changing winds. Headline inflation has eased close to the Bank of Canada's 2% target, allowing interest rates to step down from their peak. That relief is filtering through to households and businesses, but not evenly. Growth is modest. The labor market is cooler than a year ago, and confidence rises or falls with every headline on trade and global demand. Let's start with the big picture. After a stop-start 2024, GDP growth this year has been positive but subdued, tracking around the low single digits. Momentum has depended heavily on three forces: exports, housing construction, and consumer resilience. Exports have been volatile, especially in manufacturing, energy, and metals, as Canadian firms adjust to shifting U.S. policies and a more fragmented global trading environment. A softer Canadian dollar has offered some cushion to exporters, while energy infrastructure coming online, like expanded pipeline capacity and LNG terminals, promises medium-term support for volumes. On the home front, the labor market has cooled but not cracked. Unemployment has drifted into the low to mid 7% range, reflecting slower hiring and some pullback in job openings. Wage growth has come off its highs, easing inflation pressure, but households remain sensitive to borrowing costs, especially those renewing mortgages at higher rates than they locked in years ago. That sensitivity is why the Bank of Canada is cutting carefully, enough to support growth, but not so fast that it reignites price pressures. Housing is the most visible and emotionally charged part of the story. After a period of subdued sales and price adjustment, construction activity has shown renewed life. Housing starts have climbed, supported by demographic demand and policy pushes on supply. Yet the structural problems haven't vanished. Zoning bottlenecks, skilled labor shortages, and development timelines all keep supply from meeting need in the biggest cities. Affordability remains strained, and rents continue to trend high. The near-term paradox is this: construction is a growth engine, but the affordability puzzle still weighs on overall consumer sentiment. Now, the challenges. First, trade policy risk looms large. Canada's deep integration with the United States is a strength in good times and a vulnerability when tariffs, rules of origin tweaks, or sector-specific measures appear. Even the threat of new barriers can freeze investment decisions as firms postpone capital spending until the rules of the game feel more stable. Second, productivity. Canada has long lagged peers on business investment in machinery, equipment, and intellectual property. That gap shows up in slower output per worker and ultimately in a lower speed limit for growth. Third, household debt. Canadian households carry high leverage by international standards. As mortgages reset, discretionary spending gets squeezed, especially for middle-income families. Finally, regional disparities mean that a national average can hide very different realities. Resource-rich provinces swing with commodity prices. Manufacturing-heavy regions feel every tremor in U.S. demand. Tourism and services depend on both domestic and international confidence. But to focus only on headwinds would miss the opportunity side of the ledger, and there is real upside. Start with energy and resources. Canada's position in oil, gas, and critical minerals, lithium, nickel, copper, gives it a strategic role in the global transition. As LNG export capacity scales and pipeline throughput normalizes, the sector can deliver steady export income, invest in decarbonization technologies, and anchor regional development. In parallel, clean tech manufacturing, from battery components to carbon capture, offers avenues to move up the value chain rather than shipping raw inputs. Next, technology and productivity. The potential productivity lift from deploying AI, automation, and advanced manufacturing techniques across traditional sectors is substantial. The key is diffusion, getting tools out of labs and large firms and into small and mid-sized enterprises where most Canadians work. That means simplifying adoption, cloud-based services, shared testing facilities, streamlined data standards, and pairing them with skills programs that help workers use these tools effectively. The payoff is twofold: higher output per worker and better wages over time. Housing, paradoxically, is also an opportunity. Yes, it's a pressure point today, but elevated building intentions, faster permitting in some jurisdictions, and federal-provincial programs aimed at unlocking land and infrastructure can generate multi-year demand for construction materials, engineering services, and skilled trades. If completions follow through, the medium-term result could be a gradual easing of affordability constraints that have held back labor mobility and productivity. Trade diversification is a quieter opportunity that matters more with every U.S. policy twist. Incremental gains, expanding agri-food and services exports to Europe and Asia, deepening ties in the Indo-Pacific, and leveraging Canada's brand in education, tourism, and professional services won't replace the U.S. market, but they can soften shocks and open new growth corridors. The same logic applies to digital trade. Standardizing privacy, data transfer, and fintech rules with trusted partners can boost Canadian firms that sell services globally. So what should businesses and households watch? 4 dials on the dashboard. First, the Bank of Canada's policy path. If core inflation stays tame, cautious rate cuts can continue, lowering debt service burdens and supporting investment. Second, labor data. A gentle rise in unemployment is manageable, but a sharp jump would signal broader weakness. Third, housing supply metrics, starts, completions, and purpose-built rentals, to judge whether the construction pipeline is translating into real units. And fourth, export orders and energy project milestones, leading indicators of whether external demand and resource investment are stabilizing. In sum, Canada's 2025 economy is best described as low growth with room to improve. The near-term play is resilience, managing debt, safeguarding cash flow, and prioritizing investments that raise productivity. The medium-term play is capacity-building housing at scale, accelerating tech adoption, and converting resource strengths into higher-value exports. The long-term prize is a more diversified, digitally enabled, and green-powered economy that raises living standards without relying solely on population growth. Cautious? Yes. Stuck? Number. With steadier policy signals, targeted public-private investment, and a relentless focus on productivity, Canada can turn today's choppy seas into tomorrow's competitive advantage.